We welcome Daniel Morris to our conversation for more reaction on the Fed minutes and the impact on the markets. He is Chief Market Strategist at BNP Paribas Asset Management, joins us from London. You said you checked the accent at the customs, so we're glad to have you, Daniel. Welcome. You say, among other things, that the Fed is more worried about avoiding a recession than getting inflation back to target quickly. What makes you feel that way?
Well, look at what they did at the last meeting. I mean, we know going into the meeting that they were not on target for their inflation projection for this year, let alone when we get back to 2%. So there's one or two ways you can respond to that. Either you say, we're going to make that target, we're going to hike rates now, we're going to do what we said we do. Or instead they say skip, pause, whatever you want to term it. And then in addition to that, they just raise the inflation target. So I think the signal to the market, despite what Powell may have said, despite what was even in the dot plot, is that they don't want to risk a recession. They do want that soft landing. And if that means inflation,
and do you think they'll get that? What is your base case assumption?
Yeah, I think the key point is you need to get GDP growth below trend, so 1.75% in the long run. But below 1.75 can be anywhere between 0 and 1.75, or clearly it can be negative. So it doesn't have to be a recession. It just needs to be below trend, and we think that's the odds for us are higher than a recession.
And so the inverted yield curve is a signal, but not necessarily a definitive signal that a recession is coming.
It's absolutely a signal that growth is going to slow. That's very clear, and it's just historically more often than not you've ended up in the recession, but there's no, in a sense, inherent economic reason that has to be the case.
You heard Steve go through the bullet points there on labor, on housing, and inflation still being unacceptably high. Yeah. How do you interpret what we learned from the Fed meetings with where they go from here about more hikes to come?
Yeah, well, I think I'm going to have to use a phrase that they've used, which is data dependent. But we need to put that in context because, I mean, the reason, frankly, we have all been so bad about predicting growth and about predicting inflation is because we are honestly in an unprecedented world. It's not just the pandemic. It's the global lockdowns, global reopenings, and trillions of dollars of stimulus. We've never had that before. So we don't have a model that can take that into account because it's all new. So hence, we've been lousy at forecasting, and we can have all the predictions and that we want to have, but it really is just going to see how does inflation evolve, what happens with the labor market, and the Fed is really going to have to react to that.
Steve, let me bring you back into the conversation and ask whether there's anything in these minutes that we didn't know already.
No, but I might give you the experience of reading them, Tyler. I don't know if you've ever covered the courts or something like that, where you read a decision by the judge and it reads as if they're going to find him guilty, and then at the very end they find him not guilty. Mm-hmm. These minutes read like the minutes of a committee that was about to hike rates. Labor market's too tight. Inflation, no clear signs coming down. All of it amounted to or seemed to amount to the case for hiking, and yet at the end of the day, they decide to wait. I was hoping for some clarity on why they were waiting. I think Daniel has an interesting thesis here. I'm not sure I 100% buy it, but it's a good thesis that they're more worried about recession than perhaps they're letting on. But I do think they are going to hike in July. I think the groundwork has been laid for that hike, and I also think it's entirely possible they're going to move on to hike again in the next after one more skip. I think they're in this pattern here of every other meeting. They want to get the rate back up. I don't see, by the way, much change at all in the probabilities for November is the meeting we're looking at. It's still about a 35%, 36% chance of a hike, and there's still a strong, 85, a little bit higher now, percent probability of a hike in July. So I do think they are going to hike in July. I think they're going to hike again, maybe later this year if they don't get a big change in the inflation and in the jobs numbers.